Putting a thorn in the side of all the beats we've been getting lately, Andrew Brenner is the head of international fixed income securities at NAT Alliance, back here on the program with us. So, Andy, tell me what your takeaway is from the action yesterday, because before this number, bonds were starting to soften up a little bit after Bank of Japan news and an auction that was a little soft there. So that didn't last very long.
No, it really didn't. It struck the market by surprise, but it really shouldn't be a surprise, because manufacturing has been deteriorating globally for the last year and a half, and the U.S. numbers are finally starting to catch up. And I don't think it's an idea of where the Fed is going to come to the rescue, even though the odds now look like they will ease in October. We're not so sure, because the reality is this is a trade war-related issue, and the rest of the U.S. economy seems to be okay, even though I expect to see some kind of slowing in the employment numbers on Friday. You know, the U.S. economy is 70% consumer-oriented, and that is still pretty strong, especially going into the Christmas season. And you have, manufacturing is only about 12% of the economy. And, the Fed's already eased twice in the last couple of months. So, to kind of think that that another Fed ease or another two Fed eases is going to solve this issue, it's not.
Right.
You have to resolve the trade war, and it's going to look like it's a permanent solution. In other words, corporate CEOs won't won't increase CapEx. The reality is, do we need a looser Fed? Absolutely not. We just came with $168 billion of new corporate debt last month, in the month of September.
Right.
$308 billion globally.
My question, Andy, is basically which do we think about as being the current, risk to bonds? Is it going to be more big rallies like we've had on the year? Or if this isn't really recessionary around the corner, then how do we view treasuries and what is going to be moving this market?
This is, I don't see a recession coming. I think how you play bonds here is I think it's going to be a little bit more of a steepening, but I think the Fed's going to disappoint the markets in the respect that there's very little that lower rates will do to help, corporate CEOs determine whether to increase manufacturing or not. The reality is, when the problem is not rates, the problem is not credit. As I said, and I don't know how much got cut off, there's 168 billion of new issue corporates came to market last month in the U.S., 308 billion globally. And it very reasonable, if not tight spreads, and demand is still there. So lowering rates is not what's going to solve this problem in manufacturing. It's going to be that trade wars have to be resolved. As far as the market, the 10-year is right at the cusp of 1 5/8. Your low of the year was 143. I don't see that low being hit again. You could get down to 1.5. But I think the risk is going to be to higher rates, higher, longer rates, and with short rates staying pretty much locked at the lower levels. So I expect a steepening yield curve. And as that happens, I think the play is to be out of long-duration bonds. This is not a situation where you want to be long-duration bonds. Because the only way out of this, if you're not going to resolve the trade war, is fiscal stimulus. And fiscal stimulus will be inflationary and is not good for the long end of the bond market. So I would stay away from long duration bonds at the moment.
Andy, this is a really interesting point because to your statement about the steepening, we actually have gotten a little bit of that here in the last 48 hours. But to your point about the long bond, many are looking at yesterday's move and they go confirmation, and they believe that this is an affirmation, if not a confirmation, that the U.S. is going to follow the rest of the world. And we saw how quickly bonds and gold responded to that. So what then will be that kind of next piece of information to determine if we do go and test those lows? Is it going to be data, or is it, to your point, just going to be an update that is not, central bank driven, that is either from trade or is from policy?
Well, I think it is going to be partially data driven, but I think the data is pretty much lagging. And I think what we've been talking about here for a long time is how weak Europe and the rest of the world is. And parts of the U.S. economy that deal with Europe and the rest of the world is obviously faltering, and that's what we're seeing with the manufacturing data. As far as what we're going to be looking at over the next 2 months, it's going to be unemployment data. We expect employment to start weakening a bit. But as long as it's under 4% unemployment, that still strikes me as a very strong economy. And if you want more direct data, you want really close data, I would look at the unemployment claims number. If that starts going up, and it's been pretty low for a long time, 50, 60-year lows, if that starts ticking up, then I would be a little bit concerned. And don't worry about the uptick due to the GM strike, but if it gets more sustained in other situations, then I'd start to be a little bit more concerned. And then, yes, maybe you could take out your lows of the year of 140, 143 10 years, 190 long bonds. But I don't see it. I don't see it right now. And if anything, the U.S. continues to spend hand over fist. So I don't see that we're going to hit these low rates again in the long end. Short end's a different story.
Yesterday, we had the Fed funds price in a greater chance of the Fed cutting this month, Andrew, where it had been a somewhat more of a toss-up than recent meetings. The market, after looking at the response, either looking at stocks or looking at the data, decided now the Fed is more likely to cut. What do you think about that logic? Because as you just pointed out to us, manufacturing, just above 10% of the economic output. So if the Fed has, knows that as well, which they do, are they going to be quick to, bend to another cut just because of one bad data point?
Absolutely not. We don't think the Fed is going to cut this month, and we think it even goes beyond that. Not only did the reasons you just give were solid, but there's one more thing that's going on. The Fed has a real problem in the repo market. It has to increase its balance sheet. And if the Fed were to increase its balance sheet in October and ease rates, that would send the signal to the markets of more quantitative easing. And that's the last thing the Fed wants to do after just giving up quantitative tightening a month ago. So, we don't think that the Fed, if they really do need to increase the balance sheet, which they do, because the repo market, there's just not enough liquidity out there. The liquidity's been overregulated. And if they want to do one or the other, they can't do both.
So in the logic there, Andy, because this is a really important point, the logic there is if they do too many things at once, then it sends somewhat of an alarming signal. Can they handle the repo situation and frame it as a sort of structural, result of policy and rules? And it's a separate thing that we're going to take care of. Yeah, and it's going to have some balance sheet involvement. But can they convey the message that this isn't a saving QE measure?
Don Williams and team, which the New York Fed is the one in charge of the repo, have done a very poor job of portraying that in the last month. And it's been more of a crisis. These are simple numbers that were easy to forecast. They should have been doing system repos in preparation for this. So no, I think the Fed's done a very poor job of telegraphing what they're trying to do, and I think it's important that they don't do two things at once. Otherwise, they're going to send a terrible signal, and they're not going to be able to explain the markets away from it.
All right, Andy, really good stuff. Appreciate you joining us this morning. Always smart analysis here on bonds. Andrew Brenner is the head of international fixed income securities at NatAlliance.